All right, good evening, everyone. So it's a great pleasure to be here. Thank you for the invitation. And so it's really a pleasure and privilege to be talking about the US economy and also about the economic outlook. Let's see. One thing I should say before I continue speaking is that whatever I'm going to say today really reflects my views and not necessarily those of the Federal Reserve System or the Federal Reserve Bank of Dallas, for that matter. All right, with that said, I'll try to make 4 key points this evening. I'll talk about the current recovery. I'll say the recovery that we are in currently is really very different from what we experienced in the post-Great Recession period. Is there some echo? Is that fine? You can't hear me? All right, let's see if it gets better. I'll argue that the demand that we are facing, the overall demand for goods and services, is really strong. Overall output in the U.S. economy has been growing rapidly since the trough of the pandemic. Its output growth has been really strong, but has been constrained by supply, has been constrained by, in particular, labor and a number of other inputs. And I'm sure you've experienced all of that in some of your lines of work, but it certainly applied to the economy broadly. The labor market, for those who are trying to recruit, they'll find that the labor market is really, really strong. It's characterized by very robust demand for labor, for workers, with fairly limited supply. And that's kind of interesting in the sense that it's very, very different from the typical experience that we have shortly after a severe downturn. And you've all heard about inflation lately. You've all read about inflation lately. The Fed is very focused on inflation. It's part of our mandate. But as you know, inflation has been up very, very sharply in 2021. And so we see continued upward pressure on prices, on input prices, on output prices. And if I venture to look ahead a little bit and thinking about what inflation is going to look like, I would personally expect inflation to remain elevated in 2022, even though I would expect it to come down quite a bit from what we experienced last year. So I'll try to make these points in some more detail over the coming sort of 30, 40 minutes or so. All right, so let's start with economic activity first. And it's hard to dissociate economic activity from the path of COVID, because over the past 2 years now, the path of the economy has very much been associated with the evolution of COVID. So I put on this chart, the evolution of real GDP for the U.S. economy since 2006 all the way up to the last data point we have, which is for the third quarter of 2021. So it's a little outdated. Towards the end of the month, we'll receive data for the fourth quarter of 2021. So the blue line here that you see in this chart represents the overall value of real GDP, so inflation-adjusted measure of economic activity in the U.S. economy. And what I have in the orange line here is a measure or an estimate by the Congressional Budget Office of potential GDP, the amount of output that the economy can produce given the inputs that we have, the infrastructure, the physical capital in place, given the labor force that we have. So they estimate what potential GDP could be. And I want to bring your attention to these 2 gray zones in my chart. On the left side, you see the so-called Great Recession period from 2007 to 2009. And what you see here is a fairly sharp downturn in economic activity, the blue line. Potential output continues to grow. And then a big gap opens up between actual output, the actual measure of production in the economy, and its potential. And that gap takes many, many, many years to close. So output basically rebounded after 2009, after mid-2009, and grew slightly faster than potential to close that gap, but did not jump back to its potential very rapidly. And it took, therefore, many years to recover and to get back to potential. We were there, towards the end of 2018, towards 2019. We're essentially back at our potential, just when COVID hit. And here I would like to contrast the two downturns to show how, when you look broadly at the economy as a whole, how strikingly different the two episodes were. With COVID, we went in a lockdown pretty quickly. Economic activity collapsed almost instantaneously. This will be, so far at least, has been the shortest recession on record, basically 2 months, with a downturn in March and April, and then a bounce back after that. And the bounce back was equally spectacular, with an extremely rapid growth in economic activity in the third quarter of 2020, fourth quarter, and so on. Now, as you can see on my chart here, by the end of the third quarter of last year, we're not quite back at potential yet. So presumably, with pretty rapid growth in the fourth quarter, we will be quite a bit closer to that. So we are now about 1.6% below potential. But I would argue that even then, the fact that we are not quite at potential is not so much a reflection of weak demand for activity like we experienced in the prior downturn. Instead, here it has been more constraints on the supply side. If you look at demand component of economic activity, and by that I mean consumption by household, all of us put together, and throughout the economy, all the amount of goods and services that we consume, the investment made by firms in equipment, infrastructure, the government spending, all of that, the total demand has actually returned back and surpassed its previous trend. The reason the production GDP, which I show you here, is not back to its potential is because we were able to, reduce some of the inventories we were, so destock some of the inventories we had accumulated. We're able to import goods from the rest of the world that we are not able to produce as well and to meet in terms of supply as well. So the demand has been really, really strong, even if the production has been sort of prevented from returning back to its potential. All right. So if there's one thing I'd like you to take away this evening, is this chart here, where you really see this very sharp downturn and this very, very rapid bounce back, and essentially back to potential. Yes, sir?
You may cover this later, but this is a great illustration of the difficulty in the job that we're doing today, because this is probably one of the most, I don't mean this negatively, but really good recessions and
right.
recoveries that we've had.
Right.
So how do you, in your role, determine that you're actually looking at information that's valid to make good decisions, right?
Absolutely.
So much outside of.
So I think a first point in trying to make decisions, I'll towards the end of my talk, I'll talk a little bit about monetary policy, the policy stance, and what the FOMC has been announcing sort of at its last meeting. I think one of the key reasons for the evolution of the thinking around by the FOMC or by policymakers is really the recognition that we are in a different phase, or we are experiencing a different kind of downturn. I mean, obviously, we all know we got COVID. We saw COVID in 2008, 2009. It was not COVID. But in terms of the impact on the economy, the rapidity of it, the rapid bounce back of that, and the fact that supply is not really demand is really not the issue this time, but it's more like supply. I wouldn't say that everybody agrees with that. This is still quite a controversial point that I'm making. And again, I point you to my second slide, which says that these are my views and not the views necessarily of anybody else. But I would say this is still a controversial point, but it is, I think, recognizing that, acknowledging that is going to be something that's going to guide us then when we think about how to set policy, for instance. But point well taken. All right. Another, I think, key point to recognize that makes this recovery very different from what we've experienced in the past is represented by this chart. So I have on this chart with the blue line, you'll see I really like charts, and I like lines on these charts, but what you'll see on this chart is that the blue line represents overall aggregate nominal personal income. So the accumulation of all the incomes that all of us in the US economy have earned, month after month from January 2020 all the way up to December 2021. And I have with this dashed sort of black line here a trend, the historical trend. Basically, it's 4% growth. So it's nominal, which means it's the overall dollar amount of income we have. So it accounts for the fact that prices and wages, nominal wages are increasing. But what is absolutely striking here is that if you just looked at this chart without knowledge of what's going on in the real world, you would not know that there was a pandemic in the middle of that. Income has been above trend, has been growing above trend over the past 2 years. All right. So what happened? How can we reconcile that with the downturn that I showed you before in overall production in economic activity? Well, one way to think about that is to look at my red line here, which is nominal aggregate wages and salaries. And notably, the difference between the two represents the amount of government stimulus, the amount of fiscal transfers that took place. So extra unemployment insurance benefits, the various checks that have been cut by the federal government and so on. So if you take the totality of these transfers, they explain essentially the gap between the two lines. And basically, these transfers were the ones that were able to offset the huge downturn we had in income due to, in the early month of the pandemic. As you can see, back in February, March, April 2020, income fell by overall, in the aggregate for the economy, by more than 10%. Okay, so for some people, it fell by a lot more than that. So bottom line is, if you look at the overall income, it has been growing above trend. Now, even the income without the benefits, you can see, which is represented by the red line, it's now also above trend. And in fact, the two lines on top of each other, my blue and red lines are back together, meaning that we don't get much of these government transfers anymore. Okay? So to the extent that we've had a rapid recovery, one could argue a lot of that is due in part to the fiscal stimulus, to the very quick, very rapid fiscal stimulus that came in, that provided income to individuals that were not able to consume it, and as a result of that has been able to sustain demand. These big spikes, by the way, are months in which we had big checks being sent to Americans. All right. Now, what's the implication of this very strong income that got generated despite the pandemic? Well, that strong income had a direct impact on consumption, on overall consumption. And consumption represents about 70% of the overall economic activity in the country. So consumption is really important. When consumption falls by 10, 15, or 20%, well, it has a big drag on economic activity. And in fact, you can see my black line here, which is labeled real PCE, really represents overall consumption expenditure, adjusted for inflation. So it's overall the quantity of goods and services that all of us have been consuming. That fell extremely sharply, close to 20% in the early months of the pandemic. And this is simply because we were in lockdown. So we're not able to go out to the restaurant. We're not able to travel very much. We're not able to buy a lot of goods and services, and in particular, not be able to buy many services. And so services is illustrated here in red. You can see it fell even more than goods, but good consumption fell initially as well. Okay? Now, what is really striking is, again, we got a very big recovery, very sharp recovery in consumption, and now we are back on trend. Overall consumption is back on trend. What is very different from the typical recovery period, or the typical post-recession period, is the composition between goods consumption and services consumption. Typically, goods consumption falls and then slowly returns back to its trend, and services consumption remains pretty stable. These are like, all sorts of services you consume, whether it's housing services, medical services. There's a pretty steady stream of consumption of those. But the goods consumption are things that you can delay, you can postpone, you can come back to. So this was not the case this time. All right? The recovery, if anything, was led by goods consumption, not by services consumption. Okay? A very big recovery in goods consumption, and very early on. Now, as you all know, we shop somewhat differently from before. I'm sure a lot of you order a lot more from Amazon or some other providers like that. Get the things shipped to you as opposed to going and buying them in stores. So we consume differently, but in terms of the amount of goods consumed, it's like staggering how much higher it is now than it would have been had we not had any recession. So if anything, COVID forced us to change the way we operate in terms of how we consume goods, and it forced the transition that would have taken place one way or the other over time. It forced it to become now. It forced everybody to adjust. We all know about Zoom now. We all know how to operate Zoom or Teams or whatnot. We've learned that. So we've all collectively moved forward very, very quickly with technology, and we're able to actually increase our goods consumption very sharply. All right?
Good question.
Yes, please.
The services number, does that include healthcare services?
It does. Yes.
So, in other words, healthcare services may be lower because
So there are, healthcare services, so we'll have to differentiate the treatment of the... Oh, sorry, yes, thank you. The question was whether services includes healthcare services, and yes, it does, and whether what explains basically the lower services. And I would say I would differentiate here, obviously, the treatment for COVID. That's an increased demand for services, obviously. But a lot of other elective procedures got delayed and got postponed and do not appear in these numbers. So now a lot of these, I can tell you a little bit about, some of the services that remain particularly weak are especially the pandemic-sensitive sectors like travel and dining, and to some extent also hotel occupancy, although hotel occupancy is now sort of back to normal, it seems. But I'm showing you in this chart as well 3 lines. They are a little more jagged. These are so-called high-frequency indicators from over the past year, looking week by week, how much dining there is out there, hotel occupancy, and we count sort of TSA screenings, to have an indication of how much travel, the air travel there is out there. You can see that it's, 100 would be the average we had in 2019. We are not quite back to 100. We are not quite back to normal. Especially in terms of TSA screening and hotel and diners, we are still a little below that, but it's awfully close to normal now, and certainly much closer than it was like a year ago. Okay, so much of the services, sir, that you were asking about that are still relatively weak, that weakness comes from the fact that a number of these pandemic-sensitive industries, and especially dining and air travel, are not quite yet at normal, back to normal. All right. So as I argued before, a lot of the path of the economy, or in terms of economic activity and the services consumption, are related to the evolution of COVID. So we monitor, obviously, COVID quite closely. You can see that on the left side here in red, I show you you see this in the newspaper every day, so I'm sure you're all familiar with that, sadly. We see here the overall COVID cases. If you look at the very, very left of my chart, that initial little bump is actually what we were all shocked by in February and March and April 2020, when we saw these big surges in cases. Now, the scale, arguably, of this chart has become, has changed, unfortunately, over time as we go to higher and higher peaks. And we have now, with this latest variant, obviously, we reach over 600,000 new cases a day. So obviously, this recent spike that we are going through just now is really dwarfing everything we've seen before in terms of cases. Now, initially, the path of cases was really impactful on economic activity because it led to the lockdown. And we were tracking, there was a question before, what kind of indicators are we looking at and how do we think, when we think about policy. One thing we have been tracking very closely was the mobility of individuals. So we were tracking mobility of cell phone data, cell phones and other mobile devices, to see to what extent people were staying at home or they were going to some place, going to work, and in order to assess in real time the amount of activity that there was in the economy and not have to wait for the actual overall statistics to come with a couple of months delay. So we've been tracking that mobility a lot, and we saw the mobility really of the economy, of individuals in the economy, fell dramatically in early 2020. And then with each wave of COVID, mobility is falling again a little bit, but now the extent to which it's falling, that extent has become more muted and more muted over time with each subsequent wave of COVID. So with this current surge in cases, we see hospitalization increase, but maybe, hopefully, even though it comes with a delay, so hopefully this won't be to the same extent as we've seen with the Delta variant, and therefore the impact that we would expect on the economy is going to be somewhat lower than we expected that we have seen in the past. All right. Let me move on to other indicators of economic activity to suggest that make the case that economic activity is really, really strong now. These are survey measures from the Institute for Supply Management, both in the manufacturing and the services sector. Any value above 50 suggests an expansion. Any value below 50 suggests contraction. Given that these numbers are very elevated and well above 50, suggests that whether it's overall services sector or manufacturing sector is expanding very rapidly. Now, that said, we face always a supply, not always, but many businesses face a lot of supply disruption. I'm sure you experienced that in your own line of business. We at the Dallas Fed run a survey on a monthly basis of businesses, about 360 or so businesses in the manufacturing sector, in the service sector, in the retail sector. We've been asking special questions in this monthly survey regarding the pandemic and the extent to which that resulted in supply disruptions. And we've seen, surprisingly, I would say, over the past year, so since February, so you see here on the left, February 2021, then June 21, then September 21, and towards the end, November 21. So we've been asking every 3 months or so, our survey participants to what extent they are experiencing supply disruption. And surprisingly, that number has kept increasing even throughout the fall. Even in November, a larger share, so about 70% of all businesses surveyed faced significant supply disruption. And this was spread out through, especially in manufacturing and retail, but also in the service sector. And when we asked them about the intensity of this supply disruption, these supply disruptions became also more intense in November. So all that to say that the price pressures that we're seeing, that the supply constraint that we are seeing, we are not over it yet, Okay, at least this is a couple of months old now. It goes to mid-November, but it's still, we are not over it just yet. All right, that brings us to the next big challenge here in terms of constraints on the ability to produce, and it has to do with the labor market. So if I look at the overall labor market, we have every month the front page of the major newspapers show you the payroll employment numbers, and we had another release of that last Friday. So the payroll numbers for December of 2021 in the economy as a whole, and it showed that we had a disappointing number of jobs created. If you look at the payroll numbers, I'm showing you here on the left side of my chart. Again, you see the same pattern. These payroll numbers fell extremely sharply in the 1 month, in March of 2020. Basically, we lost 20 million jobs very, very quickly. But again, similar to GDP before that I showed you before, the number of payroll jobs expanded again very, very rapidly in May, June, and July of that year, so that we got this very, very rapid bounce back. Now, if you look at that chart on the left, we are not quite there at the high employment numbers that we had in 2019, a period where we were arguably close to or even beyond full employment. So some would look at that and say, hey, we still have ways to go in order to be back at full employment, which, by the way, happens to be one of the mandates of the Federal Reserve. So when we look at how to set up the stance of policy, you want to look at our maximum employment mandate as well as the price stability mandate. So looking at this chart, you would say we are still ways away, over 2% below the prior peak. Looking at labor force participation, the extent to which people participate in the labor force, that fell really sharply during the recession, bounced back to some extent, but again, we are nowhere near where we were before. So for those who would make the point that the labor market is not fully recovered yet, well, there is quite a bit of evidence here. And in fact, this is the evidence that makes the front page of the major newspapers once a month. Now, on the other hand, this was just, I wanted to make a point here about how that compares across sectors, and this is from February 2020 all the way up to November of last year. We saw that the drop in employment, whether it's for the US in red or for Texas in blue, has been pretty spread out across a wide range of sectors. So it's not that all the drop in employment took place only in leisure and hospitality. Obviously, leisure and hospitality got hit very hard, but it applies to a wide range of sectors as well. And in Texas was more pronounced in oil and gas, obviously. So the point is, employment fell very sharply, bounced back, is not quite yet at the level of 2019, all right? On the other hand, when you talk to anybody who tries to recruit anybody, they will tell you it's impossible to find new workers, or they ask for higher wages, which would suggest that the labor market is very, very tight. So when you look at a wide range of indicators, you would see a lot of them telling you the labor market is really, really tight. If you look at job openings, they are near record levels. Job openings per unemployed. So how many jobs are available out there for each unemployed? There are now 1.6 jobs available out there for each unemployed individuals, okay, in the economy, which is historically high. The quits rate is at a record level. The quits rate is when people voluntarily quit their job. Generally, it's to get another higher paying job. Okay, so people, these are people who voluntarily quit in order to get a higher paying job, and quits generally tend to predict higher wage growth because they move to another occupation, another job that offers a higher wage. So we see, record level quit rates. We see very rapid growth in wages as well. And when we survey, whether it's individuals or firms, you hear generally that it's very, very difficult to find workers, and when we survey workers, you hear it's very easy to find jobs. So generally speaking, all these indicators points to a very tight labor market, if not overheating labor market, okay? So the contrast then is, why do we see employment numbers being relatively weak? Well, you know, we've been looking at that about 6 months ago, and we've been looking at it more, I guess 9 months ago now, and we have been looking at it, you know, over and over and over every month. But you know, essentially what you find when you look closely at the underlying data is that there are a lot of workers that have essentially left the labor force due to retirements. So there are about 3 million, not quite 3 million, fewer workers now than we would have, that we had in 2019, due to the fact that they aged and wanted to retire. And this is on net. Obviously, everybody gets older over time, and there are more people retiring this way. But on net, we lost about 3 million workers due to the fact that population as a whole has aged. We have about close to 1 million individuals who have left the labor force because they have caring responsibilities. Often women with, formerly working women who have children, and who have decided now to leave the labor force, at least temporarily, in order to care for them. So an additional 0.9 million jobs, so close to 1 million jobs, disappeared because of that. We have a number of individuals presumably leaving the labor force as well due to the fear of COVID. We had, for a while, people discouraged from working due to unemployment benefits. Now these benefits has disappeared, so that's no longer a reason, but they have accumulated savings, they have accumulated cash that allows them to better search for other jobs now. And so that leaves the worker essentially in a position to wait a little longer than was the case before. And then obviously longer, you know, a number of surveys and all that point to the changing career preferences and changing sort of lifestyle arrangement for a wide range of individuals. All right. So, yes, sir.
Do you view the aging and retirements as higher than normal?
Yes. Yes, so the question was whether the aging or the retirement is higher than normal. So the aging is not so higher than normal. I mean, we're on a downward trend in terms of the participation due to the progressive aging of individuals. But the increased retirement, you know, we had, is a change from where we were before. So in 2018, 2019, there were fewer people than we would normally have expected retiring and staying in the labor force longer, and many of them have now we basically went the other way, where we have now more than you would expect individuals who retired. So it's a hard question. I don't know. You know, there are lots of surveys and analysis of that. You know, I don't know the answer to that. I mean, I would expect a fair amount of them will come back. At the end of the day, it's a quantitative assessment to know how much. All right. So let me just highlight one other number here. The key number is the unemployment rate. You know, fell very sharply. It's on my left chart here. Fell to 3.9%, which is really, really low. Not quite as low as the lows of the pre-pandemic at 3.5. But, you know, given where we're coming from, it's really, really low. And the other part is we see unemployment rate dropping from essentially all groups of the population, all sorts of education levels. And if you look at the unemployment rate by race, we see all groups essentially see their unemployment rate trending down. That's important because I mean, it's obviously important in general, but it's particularly important for the Fed, who has a mandate of maximum employment, but that mandate is also about a broad and inclusive maximum employment mandate. All right. Let me turn in my last few minutes about two things, inflation and monetary policy, and I'm sure I'm going to have some questions about that. Inflation. So inflation has been surging in 2021, as you all know. Our preferred measure is the personal consumption expenditure deflator, inflation. It's the best measure of overall inflation, but if you look at the consumer price index or your favorite measure, it may be a little higher than that, or it may be a little lower than that. Bottom line, they track each other pretty closely. So all measures say that inflation has been surging in 2021. But if you look at it, initially what happened during the pandemic, inflation initially fell. Remember that in June 2020, we had oil prices at essentially negative prices, right, for a few days. We had the WTI at negative value for a while. We're not able to find any place to store oil. So that depressed consumer prices quite a bit. But also, even abstracting from energy and food prices, overall prices fell initially in the pandemic as demand really contracted. As soon as demand rebounded, we saw a big increase in prices. And initially, I would say, a lot of that had to do with the supply disruption, the bottlenecks, the supply chain issues that we had. And we saw a surge in energy prices, in semiconductor prices, in construction metals, metals more generally, and then food commodities. So overall, a big surge in a bunch of individual good categories, but initially not broadly. We saw these surges really in a fairly small set of narrow categories. But demand was stimulated, as I argued before, by fiscal policy in part, by monetary policy as well. And now, with the tightness of the labor market that I just pointed to, you see these wage increases more broadly, and that contributing now to that broadening of the price increases and price pressures. So if you look at this chart is just to show you that there are a bunch of numbers out there that would suggest that these price pressures keep increasing. That's the only point I wanted to make. So these are a broad set of finished goods selling prices, different surveys, ISM price, the length it takes in order to deliver goods. All of these indicators show still pressure. Yes, ma'am.
Mark, I was going to ask you, I had heard that the calculation of the consumer price index and the PPI actually is different now than it was in, say, 80, 81.
Correct.
And that our inflation would actually be up, if you calculate it the same, it would be up in that range.
Correct.
It is. Okay.
No, that's right. That's correct. But I would say I won't go too much in the specifics. But the consumer price index is the problem it has. The CPI is that it's a fixed basket good. So it looks at a certain set of goods, and we keep going month after month to the same providers, looking at these good prices, evaluating where they are, if they are higher or lower, and make a note of that, and then aggregate everything to get to the consumer price index. The problem is when you have big price changes, people change their behavior. They substitute away from the expensive goods. They tend to go to the cheaper goods. If you go to an expensive store, they have this repeated high price. You tend to, over time, go to the cheaper store. And as people substitute away from the expensive prices to the cheaper prices, the good price index that does not account for that is going to have an upward bias, if you want. So that's why we prefer the personal consumption expenditure deflator, which accounts for these changes in baskets. But your point is well taken in the sense that there are other measures out there that have price indices that are way higher than that, and you could say, well, I showed you 5.7% on that indicator. The CPI was 6.8%. If you took a basket from years ago, you could get an even higher number. In all cases, directionally, it went the same point. All right. So the point I wanted to make here is that we had initially, in the first phase, big spikes in individual goods that got broadened up, and now we are seeing this broadening that's due to the tightness of the labor market, that's due to now housing prices that we've seen increase very sharply are progressively resulting in higher rents as well. And these rents, as the rents get renewed over time and new people get to a higher rent, you can see that sort of piling up on the consumer price indices. And we'll see more of that for some time. So that broadening is a phenomenon that is less acute, but happens well over time, and I would expect prices to continue to rise because of that. The good news, though, is that when you look at overall, a big determinant of inflation is what people expect inflation to be, okay? So inflation expectation is absolutely critical. If we all expect inflation to be 10%, all of you have to make decisions about how to price your goods and services, you might be close to 10%. If you all expect inflation to be 2%, whenever you make your decision and talk to your colleagues about how we should price our goods, we are going to be closer to 2%. So inflation expectation is absolutely crucial in determining how high inflation is going to be. So we monitor inflation expectation all the time. We'll look at household, what do they expect prices to be? We look at firms, what do they expect prices to be? We look at professional forecaster, what do they all expect inflation to be? And financial markets as well. When you look at these measures, there was a lot of concern initially in the pandemic as we saw the financial market estimates of inflation, essentially this, what I show you here, this blue line, the tips reflecting the inflation compensation based on tips rates, that fell very, very sharply, suggesting that market participants were expecting inflation was going to fall very sharply. There are all sorts of liquidity issues in those markets and all that. But the point is, initially there was a concern as we saw inflation fall, energy prices fall, and inflation expectation fall, that people would really start expecting low inflation for a long time, which would bring a whole set of issues in terms of interest rates, the ability to stimulate the economy, and so on and so forth. This rebounded with the rebound in the economy, and we saw inflation turn back to normal, if you want, or even a little higher than that. But they are not surging now, so they remain fairly stable. If you look at household expectations, professional forecaster expectation, financial market expectation, they remain pretty contained for now. All right, despite the fact that we have inflation numbers that are way higher than that. So that tells you that there's a good reason to believe that inflation is not going to move much higher than that. Now, obviously, those expectations could change on a dime. They could change tomorrow, and then we would want to respond to that. But at this point, they remain relatively stable. All right. Looking ahead, I have just a couple of minutes left. So in terms of the what's the outlook here? The Federal Open Market Committee, which is the committee that makes monetary policy decisions for the nation, meets 8 times a year in scheduled meeting. The last meeting was mid-December of last year. And 4 times a year, they come up with projections for the economy. And they publish those projections. I mean, we make forecasts all the time, but they publish those projections 4 times a year. And it's called the Summary of Economic Projection. So what was in this Summary of Economic Projection? Well, these numbers are really, really small here. You cannot really read that much, but look at the pattern. On the left side, you have real GDP growth and what they project real GDP growth to be. They see real GDP growth being extremely high, very high, and then coming back down to its longer run growth, about 2% over the coming year. So this is going to 2022, 2023, and 2024. The unemployment rate, the middle panel, jumped up to 14.8%, came back down, is now at 3.9%. The FOMC expects it to sort of continue to decline and reach about 3.5%, with some range, different opinion above and beyond that. So some people would expect the unemployment rate to fall even below that. And then the inflation side, as you can see on the right here, we see the inflation spiking in 2021 and then coming back down to around 2.5% in 2022 on average. So that's the midpoint here of the projection, and with a range that goes from anywhere between 2 and slightly above 3% as well. So still elevated inflation, but not quite as high as what we've experienced this year. And then sort of a inflation that stays above target over the coming year, but then returning to target towards the end of the forecasting horizon. So in terms of monetary policy, what comes with that, and I'll conclude with this. In March 2020, the Fed cut the federal funds rate to the short-term interest rates to near zero, as you can see here with my black line. In September of 2020, it issued so-called forward guidance. And what the FOMC said is, we are going to keep the federal funds rate at zero until 3 conditions gets met. At least 3 conditions get met. One is labor market reaches full employment. 2, inflation has risen back to 2%. At the time, it was around 1.25%. And inflation is on track to exceed 2% for some time. So they really wanted to make sure that inflation goes back up and goes above the 2% target. Well, the second and third criteria definitely got, more than met. The issue has to do with the labor market. Are we back at full employment or not quite? And as I hope you got from my presentation, there's a debate there, because if you look at the employment, you can say, no, we are not quite there yet. If you look at a bunch of other indicators, you're more than there already. Hence, kind of a discussion around, is it time to raise rate or not? At the last FOMC members, all of the participants now projected that in 2022 there would be a rate increase, at least a rate increase. And this is the so-called famous or infamous dot plot produced by the Federal Open Market Committee. It shows you on the very left, everyone projected that for 2021 we would stay at low rate, close to zero. And then each dot here for 2022 represents one individual participant's, so one FOMC member's assessment of what would be appropriate policy. You can see the majority, so about 10 participants, would see 3 rate increases in 2022, another 3 rate increases in 2023, another few rate increases in 24, and so on. Okay? But there's some disagreement around that. Not everybody is on the same page. But all of them saw increases coming for 2022. On asset purchases, the Fed has, in March, dramatically increased its asset purchases, so purchase of treasury securities, mortgage-backed securities. This is shown on my chart here on the right. Initially, this was associated with market functioning, and later on trying to provide stimulus to the economy. In December 2020, the FOMC said it would keep making large amount of asset purchases, about $120 billion a month, per month, until we would reach substantial further progress towards maximum employment and stability goals. And by November, they decided that they had reached that point, and they started so-called the tapering of these asset purchases. Given the high inflation numbers and the progress we made in employment, the FOMC in December even accelerated the pace of tapering, meaning that they would essentially bring the balance sheet pretty closely to a halt. And now it's projecting somewhat by March 2022, so in a couple of months, to bring that balance sheet here to a halt. There's a lot of discussion about normalization of the balance sheet or adjustment towards that balance sheet, and I can take questions on that if you're interested. In any case, let me conclude here. Demand is strong. I argue that employment continues to improve. It's likely held back by some supply factors. The inflation has been well above the Fed's 2% target. I would expect it to moderate this year, but still to remain somewhat above its target. There are still, with all that said, a bunch of risk around these projections, and the risk remain very significant, most notably COVID, but there are a number of other risks as well, both national and international, that we keep monitoring and keep in mind. So with that, I'll just flag that my colleague, Pierre Arrhenius, will give a presentation on February 3rd online, and you can register at the Dallas Fed website. on the Texas economic outlook. We are always happy to have new participants in our surveys. So if you are interested in that, please, you can look at this QR code with your phone and then subscribe to any of our publications or participate to any of our surveys. We really value that. With that, thank you very much, and I'm happy to take any questions. Yes, sir. Yes, sir.
Reducing the balance sheet beyond renewals, right? I think most of the purchases have been longer dated bonds, but there may be a mix there. What's the thinking on?
Well, yeah, so the thinking is, and you might have seen, the Federal Reserve sort of released the minutes of its FOMC meeting not so long ago, a couple of, late last week. The thinking is, well, the sequencing in terms of the normalization of the balance sheet might remain pretty similar to what we experienced last time around. People have gotten used to that, by which I mean, okay, finish the taper, keep the balance sheet fixed for some time, start raising rates potentially, and then if things work out normally, then let the balance sheet sort of run off slightly. Now, the difference, though, is what might be different this time is that the timing between each of these steps might be very different from what we experienced. Last time around, between the first rate increase and then the start of the decline of the balance sheet, it took a long time. This time, given the strength of the economy, given the inflation pressure, and given the strength in the housing market, given the fairly loose financial conditions, the committee has revealed in its minutes essentially that it's open to the possibility of dramatically shrinking these time intervals. So we would see a decline of the balance sheet pretty quickly.
But presumably you'd let maturity be your friend.
Correct. So there are actually quite a few short-term maturity securities in the Fed's holding. So even if it wanted to maintain the balance sheet constant, it would have to keep buying a lot in order to offset those maturities. So presumably they can let them run off. I think. Oh, sorry.
First of all, I want to say thank you for contributing to the Fed in Dallas, how great they are here.
Thank you.
How is Dallas treat you?
Dallas treats me very well. It's very, very good. Absolutely. No, so I'm
You've been here how many years?
4 years now. So as Jim mentioned in the introduction, I'm native of Switzerland. So I left Switzerland many years ago. I was in the Northeast for a long time. And I never thought I would move that far west, but here I am, and I've been here for the past four and a half years now. And I have become a little more learned about football than I was before. Let's put it this way. Yes. But thank you. Thank you very much. Thank you. All right.
Turn in your CPE cards. We'll see you on February 7th. Be safe.